Jamie's first idea is Blackstone. Tell us about it, Jamie.
Yeah, so Blackstone is probably the largest private equity company in the world. And really, we think now is a great time to get into the name. So just consider these couple of stats from their Q2 earnings release from a couple of weeks ago. So their fee-related earnings up 45% year over year, assets under management up 38% year over year to just under $1 billion. So these are staggering numbers. It's a behemoth of a company. And really, it's brand name that drives the investor interest. And so they're able to leverage that brand and collect private equity investments. And, they're moving more into the retail market as well. So a new sector opening up. And they see still a very good fundraising environment, going forward, despite the market volatility. They've also done really well in the real estate market. And they're a little bit insulated, we think, from the higher interest rates, given that their portfolio mostly comprises of residential in the U.S. and then as well as industrial. So both of those are short duration real estate assets, as you would call, so that the rents turn over really quickly. So when you're in this inflationary environment that we've seen, you're able to raise rents to offset that inflation typically over time and continue to earn a good cash flow margin. It's a company that in the last 5 years, the revenue's doubled and their headcount, which is their main cost, is up about 30%. So you get a lot of leverage to gathering assets, and it's a company that's proven it can deploy that capital, earn attractive rates of return. So we think the stock, it's down about 30% this year. The earnings estimates for 2022 are actually up about 5%. So you've seen that multiple come down, and we think now's a good time to get in. It pays a variable dividend based on when it realizes investment returns, but it yields around 5% on a go-forward basis. So, a nice yield that's grown pretty strongly as well historically.
Your next idea is BP, and you reckon this stock trading at a significant discount to other giant oil companies.
Yeah, so I mean, BP it definitely trades at a discount to the Chevron, probably the gold standard for these super major integrated, Exxon as well. But we see BP as a company that's really transformed itself over the last 2-3 years under its new CEO. And when you go back, BP obviously had the Macondo disaster back in 2010. They're still making payments on that sort of their punishment for what happened. But that's something that's been priced in. The company is operating much better now. Given the strength in oil prices, it's gone from $32 billion in debt down to 22 in the last year. At the same time, it's bought back a ton of shares. I think 7% of the company has been bought back over the last year. And more share buybacks come forward. And they just raised the dividend 10% in their most recent quarterly results. And it really gives you, when we talk about where a company operates, it has a nice balance between, they have LNG, they have North American natural gas, they have offshore oil, they have the gas stations, which is a nice little asset as well. So it does give you balance, and we still think we're going to be in an energy-constrained world, and BP will be one of the companies that benefits from that. And yeah, we see that's the share price re-rating, the debt coming down more, and we think that there's better returns ahead for BP.
Right. I'm just looking here at the yield for the U.S. listed stock. Not massive, well, 4.7%. Not too shabby either. Okay.
Yeah.
And the U.S. listed stock up 16% this year. Intuitive Surgical, there was a stock split there in October of 2021.
Yeah, so Intuitive, off the top of my head, I think it was a 3-for-1 split. But Intuitive, it's the leader in robotic surgery. And so this is an area that we still think is relatively early days in how it's ultimately going to play out. Intuitive has a massive head start. The two large healthcare companies, both Medtronic and Johnson & Johnson, are looking at entering this market, and they're having some troubles. They've been trying to build out a competitor to Intuitive's Da Vinci surgical unit for the last, call it 5 years, and they keep having to press it back. The development timeline keeps getting extended, and that just lets Intuitive build its lead further and further. And the other interesting part about Intuitive is really that recurring revenue model that really drives the financial performance. So they place the units, It's a big upfront capital cost for a hospital or a healthcare unit to buy one. But once they get that in, then they train surgeons to use it. And then you start to see that utilization improve, and they earn revenue based on selling tools and instrumentation for those surgical procedures as well. So you really get that leverage to increasing procedures using their robotic surgery units. Then they also have a new product as well called Ion, which is good for diagnosing, tumors in the lung. Definitely to do biopsies and such, it's much less invasive than some of the older styles of surgery that would be used. So, it's a great name. We think it's expensive on a PE basis, but it's a very highly profitable, and we think it's going to be one that's going to be able to grow 10, 15% top line revenue for the next decade.